Welcome to Bulls, Bears, and Bill, a weekly Dalton Community television program on the financial markets. Brought to you by Bill Schmick, founder of Onota Partners, and me, Rachel Branch, co-host. And when Bill says financial markets, he means all of them. On each program, we will continue to share with you, our audience, why the markets did what they did and where they are going in the weeks and months ahead. Bill writes 2 columns weekly for several media and newspaper organizations throughout the country. The substance of Bulls, Bears, and Bill.
Well, how are you? It's Monday in the afternoon, and as we sit here and do this show, President Trump and President Zelensky are meeting at the White House. It's a pretty critical day for the markets. As when I left, the markets were flat. As I said, he just met with Zelensky. They're in the middle of a talk, and after that, Zelensky and I think it's 6 European leaders will then meet with President Trump. And the subject, of course, is whether or not we have any hope for peace between Russia and the Ukraine, or if we're going to continue in this state of war for another how many more years, I don't know. It will have some impact on the market, at least today and probably this week, depending upon the outcome. My bet is if there is some sort of breakthrough this afternoon between the European leaders, Zelensky and the White House, that would be positive for the markets because war and killing is not positive for the markets, and we've been under that pressure for the last 3 years. On the other hand, if the market is, if the meeting and the outcome is inconclusive, meaning that the war continues in some shape, way, or the other, I think that would be some bit of a slight disappointment to the markets. Specifically, though, there are certain things that would probably go down. For example, the price of gold and gold mining stocks that have the war has basically supported the price of gold for several years. So if there was some true, real breakthrough, I think in the very short term, you could see a pullback in silver, gold, platinum, palladium, so forth and so on, which, by the way, if that were to occur, I would purchase gold for sure on any pullback. On the other hand, if the market deems that whatever is happening would be smoke and mirrors and that the war would continue, then you could see gold at least start to move up fairly quickly and sharply. So that would be your immediate response, depending upon what happens.
Okay, let's switch gears a little bit. Are we starting to see the tariffs show up in the inflation data? And if so, how does an everyday person understand what that means?
Well, the everyday person, which is you and I, will find out very shortly because I suspect that what we're going to see in the months ahead, and maybe next month, if not now, we're going to see certain products, produce and things like that, start to climb higher in price. As it stands right now, why we haven't seen the tariff impact in the grocery store or in our purchases, autos and everything, so is because even though President Trump announced reciprocal tariffs in April, you may recall that every time there was a deadline, a month deadline, a 3-month deadline, etc., that deadline was extended and pushed back. So most of the tariffs have never been implemented until very, very recently. Yes, there was a 10% tariff that was implemented across the board, every nation, and that was done in April. What you're starting to see right now, you saw it in the producer price index. What is that? That's the inflation gauge for commercial businesses, whereas the consumer price index is more about you and I and what we're experiencing. Well, just last week in the producer price index, the market had a real surprise. We were anticipating a 0.2% increase in the PPI, and it came in at 0.9%. That may sound like a small amount to you and I, but it was fairly strong and robust. And what the explanation for that increase was, sudden increase, was the tariffs were going to start biting. And they were. Up until now, the 10% tariff and 15% tariffs and any other tariffs that you might have heard the president has implemented, what's happened is the corporations in the United States have been eating that tariff. 64% of the tariff increases have been absorbed by businesses. However, I suspect that that is coming to an end. They can't literally take 100% of them. And as the tariffs start to bite into food and products and so forth in the economy, they're going to have to pass more and more and more of those increases in prices to us, the consumer. So it's one of the reasons why, number one, for the last 3 months, I had been predicting correctly that the consumer price index would decline, and it did for the last 3 months. Now, the markets are such that when something like that occurs, 2 or 3 data points in a row, they call that a trend, and their expectation is that trend will continue. I disagree. In fact, I think that from here onwards through the end of the year, we're going to see the consumer price index and inflation climb higher and higher.
Wow.
As the tariffs start to implement,
Okay.
and that those increases that we've just got. Donald Trump basically made a deal, we hope he has, with Japan and the European Union. Now, he slapped tariffs on both of them. Those they'll be implemented now. For the rest of the world, starting August the 9th, August the 9th, I think, no, August the 2nd, he implemented tariffs as high as 50% on countries like India, and they're in place now. And so all of those higher prices that we're going to pay because of the tariffs are going to start showing up in the data. And this is going to be a problem for the United States. It's going to be a problem for the stock market, and it's going to be a problem for you and I.
Yeah, definitely. Over the last few months, unemployment seems to be increasing, with less jobs being created. Is this going to escalate, or is it just a blip? And do the numbers reflect those job seekers who have stopped looking out of despair with no apparent avenue to a livable wage position? In that regard, in your article, how is full employment defined?
Well, let's start with the last part. Full employment is a theory. It's never going to be achieved. Okay, what the argument is when labor is used the most efficiently in an economy to produce goods and services. But economies are not efficient. And so in this situation, we're never, as I said, I don't doubt we'll ever see full employment. However, employment is beginning to slow. Now, I don't believe that employment will slow to some degree where we're going to have to panic. I see it slowly decreasing somewhat, But that doesn't mean that there aren't millions of jobs out there that are going unfulfilled. What's really happening is there is a historic cross current between people who are employed and people who aren't employed and jobs. What do I mean? Well, when I look at the immigration regulations and efforts here in the United States that's now been in place for 6 or 7 months, deportations and so forth, a number, who knows how many we're talking about, 500,000 employed workers are less employed. Some are being deported, others are in hiding. And what's happening is that those jobs are still out there, they're just not being filled. And there's a cross current between those immigrants and people like you and I who are basically retired or going to retire, that are leaving our jobs. And there's this time period in which those jobs need to be fulfilled. You know, who has the skills to take my place? Who wants to pick tomatoes on a farm in wherever, California?
In 120 degree heat.
Yes, yes, exactly.
With fires all around.
So as this sort of complex situation continues to roil the labor market, we should see less employment, even though the jobs are still there. We just have a period of time where they're not being fulfilled. And then to throw on top of that artificial intelligence, what's happening in that situation is that, I just did a column on this 2 weeks or so ago, that what is happening is artificial intelligence is beginning to take entry-level jobs and fill them. And what that's doing, it's hurting college-educated students who are looking for jobs now in entry-level positions in things like computer science and software and so forth. The unemployment rate among that, I'd say from 21 to 28-year-olds, college-educated, is double the unemployment rate of the rest of the nation, and increasing. So that's also in the mix.
Wow. Markets are betting on an interest rate cut by the Federal Reserve in September. Is that justified, and why?
Well, we'll know a little more about that at the end of the week. Jerome Powell, the chairman of the Federal Reserve Bank, will be speaking at 10 o'clock on Friday morning at Jackson Hole, Wyoming. It's the annual symposium, economic symposium, where central bankers and movers and shakers in the financial markets get together and talk about esoteric things. It's normally a time when, if it's before the next FOMC meeting, Federal Open Markets Committee meeting, that is, I think, September the 17th. So the market is waiting with bated breath for Powell to talk about what, if any, changes there may be when the Fed meets again September the 17th. Now, no one knows what he's going to say, but what is happening is that there is an 86 or 87% chance, or bet it, that the Fed will reduce interest rates by 25 basis points in that September meeting. Now, what is Powell going to say? Is he going to throw cold water on that idea? Is he going to talk in a sense that it could happen? Or is he going to hint to us that, yes, we expect one to happen?
Bill, what's 25 basis points?
One quarter of 1%.
Oh, okay.
And just recently, last week, there was a 100% bet that the Fed was going to reduce at least by 1/4 of 1%, but could actually do a 0.5% cut. That betting has dropped dramatically over the last week. And why? Well, because of the producer price index. That's why. after months of declining inflation, we suddenly see the producer price index that shot up. So inflation is shot up in the commercial business sense. And the way it usually works is there's a 1 to 2 month lag between the producer price index results, and that starts to show up in the consumer price index, our index.
Yeah.
So suddenly, from 100% guarantee that the Fed's going to cut, that's dropped down, and the idea of a half a percent cut, that's gone out the window. And there were expectations that this year the Fed could cut 3 times. That's really diminished. Now, is it warranted? This is my opinion. No. Why? Well, first of all, I just said to you that I don't think unemployment is going to drop dramatically. I explained it's cross currents there, but I see some losses of jobs, but nothing dramatic. But at the same time, I see inflation starting to move up. So if the Fed does cut in September the 17th, let me term it as a policy error.
Well, may I add something about the effect that AI is going to have on employment as it moves in. This reminds me of when technology, computers came in and robots took over jobs, and then AI now, and you're talking about AI and entry-level jobs.
Yeah.
There's going to be an impact. This might be for another show, but I'd
Yes,
throw that in.
AI isn't going to impact in the short term the inflation rates.
For sure.
And what is going to impact it is, as I said, the tariffs that are going to start biting into the economy. That's what I'm worried about. That's what I'm predicting is going to goose the consumer price index, producer price index. And in an era or an environment of rising inflation between now and, say, the end of December, why would the Fed cut interest rates? Wouldn't that just add to the inflation rate? Yes, it would. Okay. What the economy's growing, I mean, it's not growing at 3%, but it's growing at 1.5% to 2%. Unemployment is manageable. Okay, I don't see it increasing that much. And here we have inflation going up with more inflation to come. Because, remember, we had I'll just call it the big, beautiful bill.
Right, big, beautiful, so-called.
Yes. Okay, that spending is going to start kicking in as well. Well, what happens when you're spending and the economy is already growing? More money, more growth, more inflation. And then on top of all of this, we're going to cut interest rates. Now, why would we? Because we're cutting interest rates because what happened was in the last non-farm payroll report, what happened was there was a revision of the number of jobs the economy created over the last 3 months. And it was a dramatic revision for the last 3 months. It was so dramatic that what Donald Trump did was he flew off the handle and he fired the head of business labor statistics. Now, that revision is there's nothing political about the loss of jobs over the last 3 months. But it stunned the market. Market initially had gone down for a day or two. But suddenly, the world is on fire. Oh my God, look, the number of jobs. Look at the revisions over the last 3 months. Oh, we must be going, unemployment must be going through the floor. And so this sparked the idea that what the Fed needed to do immediately was to cut interest rates to save American jobs. Now, question is that true or is that false? Should the Fed jump at that, worry about that, and emergency meet in order to cut interest rates and keep cutting interest rates because there have been revisions to the job? Or should they wait and see if this is a trend or not? Now, I'm of the position that there's no need to cut interest rates now in September. Let's wait and see if these if unemployment starts to spike, which I don't think will happen.
And I also understand that revisions are not unusual.
It's part of the deal.
It's part of the data that is
Yes.
ongoing in its collection.
Yes, and it's been, to get a little wonky, the problem has been, I mean, President Trump immediately said, oh, it was political, to make him look bad. No, I don't believe that's the case at all. What I believe is the Bureau of Labor Statistics is using antiquated methods in order to gather the data they need in order to predict the non-farm payroll numbers or this number or that number. They are still calling people on telephones, okay, for this data, okay? It's the same reason why I think that political polls have become practically useless, because the same methods of gathering data are antiquated. And in the case of the Bureau of Labor Statistics, their funding is being cut, along with so many other agencies' funding is being cut. So they don't even have the money to improve the situation. So what happens, as an example, I called Joe over at company A, B, and C in Alabama. Joe doesn't answer, okay, and Joe doesn't get back to me, and it's time for me to put down a number for the non-farm payrolls. Well, if Joe isn't calling me back, and Joe said X the last time, maybe I should just add a little to what Joe said this time and estimate it. And that is happening over and over again, increasingly so since, I don't know why, since the COVID pandemic. And so the information we're gathering is slow to come in or non-existent. And so more and more of the agency's results are based on their best guess, the best estimate, okay? So that puts into question the government statistics, which were and have been through the years sort of a golden rule, okay? And they're becoming less and less so, which, if you can imagine, economists and the markets and so forth have been dependent on this government data for decades and decades. To suddenly worry about how accurate it is another danger to the economy and to the stock markets.
As well as the loss of federal workers.
Yeah.
Doing that work.
Yes.
Yep. Well, this one will just change just a little bit. Will the Fed chair, Jerome Powell, give us a hint this week of what will happen at the September meeting in time for your columns?
Yeah.
I can't resist.
I know, yeah. And 10 a.m. on Friday morning, so I may have to wait before I finish my column. Here's my bet. I'm thinking that he won't satisfy the markets by saying that a interest rate cut is forthcoming. I think he'll sit back and say, once again, we are data dependent, and based on the next two data points, both of which, the CPI and another non-farm payroll data, both are going to hit before they meet on September the 17th.
Which is a good thing.
Which is a good thing for them, because it'll supply them with a little more data. Now, if the market is, as it is, it's convinced that Friday he's going to come out and say, don't worry, we're going to cut interest rates in September. And half of why they believe that is because they think that the president's pressure on Jerome Powell and on the Fed overall to lower interest rates has got the Fed scared. And I don't believe that they are at all. I think that they're still going to continue to do what they're doing, data dependent. Let's see what the the numbers bring before we meet and decide what to do. So we'll see what happens, but that's my bet.
I think they know what they're doing.
I hope so.
And for our last question,
Yeah.
are you still bullish on the markets? And what's your prognosis until our next Bulls, Bears, and Bill program?
Well, the last time that we were here, I cautioned that we might have a short-term pullback, which we did have. I think the NASDAQ the following week was down 4%. The S&P down less, but it was mild. I'm getting more and more concerned that we've got, a 5, 6, 7% pullback in front of us as early as this week and maybe next week. I could be wrong. We're in a situation where we could have one more boost up. Let's say, for example, if Jerome Powell on Friday said, we're going to guarantee we're going to cut rates in September, and or that the President Trump, Zelensky, and the European leaders all come out kumbaya this afternoon and say the war is over, or whatever the statements are, indicates that there's a wind down to the war. That could also be the trigger for one last hurrah. Okay? Now, what am I talking about if I say one last hurrah? I use the S&P 500 index as my benchmark. That's what I watch. I don't watch the Dow. When I think I left, the S&P 500 was around 6,480, something like that. I could see, in that case of a last hurrah kind of meltdown, that we might have 100 points in the S&P 500. The way the markets have been going, that's maybe a day and a half to 2 days, depending upon the appetite for it, or it could be a week. I don't see the market after that, let's say the S&P 65.50, 65.70. Okay, and remember, we're at like 64.80, 64.90. That's not a lot. That's not a lot. That's the bull case, that we're up another 100 points or so. The bear case is that we're entering now a pullback, not a market correction. A correction would be 10% or more. But something like, as I said, 500, 700, So 5%, 7% pullback from here or a little higher is what I'm expecting. Sometime in September, we're already, what is this, August the 18th? Mm-hmm. Okay, sometime between the end of this week and sometime in September. Next week to 3 weeks. So I'm cautious. Okay, I just don't know exactly when it's going to start. But you'll know, because we'll be back here next week.
Thank you.
You're welcome.